Right now, sitting inside your banking app, is a silent leak draining thousands of dollars from your future, and you probably check it every single morning without noticing a thing. Pause. Most Americans believe that as long as their money is sitting safely inside a bank, they are doing everything right. They work 40, 50, 60 hours a week, trade their precious youth and time for a paycheck, and deposit it into the first account they opened when they were 18 years old. But here is the brutal truth that Wall Street banks will never advertise on a billboard. Keeping your hard-earned cash in the wrong account is not just playing it safe. It is slowly guaranteeing your own financial failure. Every single hour your money sits parked in a standard checking account, inflation is quietly eating away at your purchasing power like rust on an old engine. You think you have $10,000, but in reality, that money buys less grocery, less gas, and less freedom with every tick of the clock. Meanwhile, the megabanks are taking your exact deposit, lending it out for mortgages and auto loans at 7 or 8% interest, and handing you back literal pennies. Today, we are breaking down the exact mechanics behind two essential financial tools that 99% of people completely misunderstand: checking accounts versus savings accounts. Which one do you actually need? Where should every single dollar of your next paycheck go? And how can a simple behavioral shift save you over $25,000 across your working life? If you are tired of working hard just to watch your money evaporate into thin air, hit that subscribe button right now. We build real, data-driven financial roadmaps here every single week to make sure you keep the wealth you build. Let's protect your future together. To understand how this silent trap works in the real world, meet two people living in the exact same suburban neighborhood, Mark and Sarah. Both are 32 years old, earning an identical $75,000 a year as project managers. They pay the same taxes, rent similar apartments, and share the exact same dream of one day owning a home and retiring with dignity. But their financial realities 10 years from now will look completely different, all because of where their paycheck lands on Friday morning. Let's look at Mark first. Mark is hardworking, responsible, and terrified of debt. He doesn't spend lavishly, but he keeps his entire financial life inside a single traditional checking account. Every time his direct deposit hits, it lands in checking. His rent, his groceries, his utilities, and his weekend takeout all come straight out of that same bucket. At any given time, Mark keeps a steady balance of $20,000 in his checking account. When he opens his banking app and sees that five-figure balance, he feels a sense of security. But Mark doesn't realize what that $20,000 is actually doing. The national average interest rate on a traditional checking account, according to official FDIC data, sits at a pathetic 0.07%. On a $20,000 balance, the bank pays Mark a grand total of $14 a year in interest. $14. That barely covers a single lunch combo at a drive-thru. Meanwhile, with core inflation averaging around 3% annually, Mark's $20,000 loses $600 in real purchasing power every single year. Over 10 years, without adding a single dime, Mark's safety net loses over $6,000 in real economic value, while generating just $140 in total interest. Mark feels safe, but he is financially bleeding out in broad daylight. Now look at Sarah. Sarah earns the exact same paycheck, but she operates with a strict, automated two-account architecture. Sarah uses her checking account strictly as a transactional highway, not a parking lot. She keeps exactly 1 month of living expenses, about $3,500, in her checking account to handle immediate bills, auto drafts, and daily living. The rest of her emergency fund and short-term capital, $16,500, is immediately rooted into a high-yield savings account earning a competitive 4.5% annual percentage yield. Her money is fully protected by the FDIC up to $250,000, completely liquid, and completely separated from her daily debit card impulse spending. Let's run the exact math side by side. Over that same 10-year period, Sarah's $16,500 compounding at 4.5% generates over $9,100 in pure, effortless interest income. While Mark earned $14 a year and lost purchasing power, Sarah's savings account actively defended her wealth against inflation and paid for an entire year of her emergency fund growth. But the financial gap between Mark and Sarah isn't just about interest rates. It is about human psychology and the dangerous illusion of artificial liquidity. When Mark looks at his checking account and sees $20,000, his brain subconsciously registers abundance. When unexpected expenses arise, a weekend trip with friends, a new gadget, an expensive dinner, his checking balance absorbs it without friction. There is no psychological barrier between his daily spending money and his life savings. He accidentally spends his future because his future is sitting right next to his grocery money. Sarah, on the other hand, creates intentional friction. Because her primary wealth sits inside a dedicated savings account, her daily checking balance always looks modest. When she checks her balance before making a discretionary purchase, she sees $300 of disposable cash, not $20,000. This psychological barrier eliminates lifestyle creep and enforces natural discipline without feeling like a punishing diet. So why do these two accounts exist in the first place, and what are the structural rules governing them? A checking account is engineered for maximum liquidity and unlimited transactional volume. It comes with a debit card, paper checks, online bill pay, and zero restrictions on how many times you swipe your card in a month. It is your financial airport terminal. Money lands, passengers transfer, and flights take off. You should never build a permanent home in an airport terminal. A savings account is designed for asset storage and capital preservation. Under federal guidelines, savings accounts traditionally carried withdrawal limitations to encourage long-term retention. While the Federal Reserve paused the mandatory 6 withdrawal limit under Regulation D, most institutions still maintain structural buffers to discourage daily micro-spending. The primary purpose of a savings account is to earn compound yield while keeping your emergency capital segregated and secure. But here is where millions of Americans make a fatal mistake. They fall for predatory banking fees. Traditional checking accounts often hit consumers with monthly maintenance fees of $12 to $15 unless you maintain a minimum daily balance or set up mandatory direct deposits. Over 5 years, an inactive or poorly managed account can cost you up to $900 in junk fees alone, as documented by the Consumer Financial Protection Bureau. So what is the exact playbook you should execute today? First, immediately audit your current banking setup. Identify your average monthly fixed expenses, rent or mortgage, utilities, insurance, groceries, and debt minimums. Keep that exact amount plus a small buffer of $500 inside your checking account. This guarantees zero overdraft risk while stripping away excess cash that could be spent impulsively. Second, open a dedicated high-yield savings account with an FDIC-insured institution. Transfer every single dollar above your checking buffer into this yield-generating engine. Build your emergency fund here until you reach 3 to 6 months of essential living expenses. Third, automate your wealth flow. Set up your employer's direct deposit to automatically split your paycheck on arrival, 80% to checking for living costs, and 20% directly into savings and investments. When you remove human emotion and manual transfers from the equation, building wealth becomes an automatic background process. Money is not just paper or digital digits on an LED screen. Money is stored human life energy. Every dollar in your account represents hours you spent away from your family, your passions, and your sleep. Leaving that energy parked where it decays is a quiet betrayal of your own sacrifice. Choose to be intentional. Move your capital from where it sits idle to where it works for you. Take control of your accounts today, build your buffer, and let your money fight for your freedom. What is the current split between your checking and savings accounts? Drop your thoughts in the comments below, share your strategy, and let's master this game together.